Good afternoon, everyone, and welcome once again to the RealNex webinar series for a market update with Dr. Jeff Fisher. And today we're delighted to have a special guest, Terry Tallen, Chairman and CEO of Tallen Capital Partners. As you know, Jeff is head of data and research for RealNex and has been providing updates based on his work with NAREIT over the years. And this quarterly update will bring us up to speed as of the end of the third quarter. And we've seen some turns in the marketplace since the last call. So the topic of the day is, has the CRE market stabilized? And Jeff will give us his insights and findings based on his research. And we brought in Terry as a special guest, given the particular impact that this pandemic has had on the retail sector. And Terry's company's been a leader in the retail market over the years and has a number of power centers, community centers, and assets being repositioned, and will provide some real-time, on-the-ground insight as to what's happening and some of the winners and losers that are playing out in the retail side of the sector. So Terry, we're delighted to have you with us today, and of course Jeff, to have you back as always. So before we get started, as everyone's filing into the room, we will give a little bit of an intro on an update to RealNex. We are delighted to have a new release of the RealNex platform that just came out last month, and the RealNex Navigator is a significant enhancement and upgrade to the RealNex solution. Hopefully all of you that are clients are enjoying it. Others that have not had the chance, we'd love to provide you a demo, and we'll give you a brief introduction to it now and then get started with the program.
Charting your course in today's complex commercial real estate industry is harder than ever. You need 20/20 vision to see beyond the horizon, beyond the obvious, beyond what everyone else can see. RealNex Navigator delivers what you have been searching for: the ability to do more with less for less. Simplify your work life and lower your costs with RealNex Navigator, the only solution you need. Savvy owners, asset managers, brokers, and investors rely on RealNex Navigator to get better deals done faster. Navigator is the most complete commercial real estate technology solution for accelerated lead generation, authoritative financial analysis, awesome presentations, amazing marketing, and successful deal management. Navigator leads you to unbeatable opportunities and unique solutions for you and your clients. Manage deals with ease while consistently impressing clients with detailed analyses, meticulous reporting, and successful execution. With RealNex Navigator, you will master the market. Enjoying complete visibility, you will know about the hidden opportunities and the nuances of each property. Readily track comparable sales and leases, and swiftly identify and target the most active buyers, sellers, and tenants. Efficiently collaborate with clients using the sensational RealNex Tourbook leasing app and run accelerated sales processes in private and secure virtual deal rooms. Eliminate redundancies and save time with expert development, property investment, and comparative lease analyses, and swiftly create an astounding array of professional, elegant, and consistently branded marketing materials. When it's time to go to market, RealNex Navigator can economically run highly targeted email campaigns to your private prospect list or instantly tap into the vast RealNex community to assure no stone is left unturned. You can even leverage 3D virtual reality to improve deal cycle times for buildings and spaces and rapidly assure properties work perfectly for clients. To turbocharge your productivity and results, navigate the competitive commercial real estate landscape with RealNex. Find your path to increased success by taking a deep dive demo of RealNex Navigator or sign up for a risk-free trial today. You'll be glad you did.
All right, thanks for enjoying that with us. And again, we are really excited and proud of the new release, and hope you'll, those of you that are using it or enjoying it, love your feedback. And those that have not send us a message, give us a call, and sign up for a demo. We'd love to share with you. So Jeff, let me turn it over to you, and we'll get started. Remember, everyone, during the session, feel free to tap in the question box, and we will do our best to address all of your questions towards the end of the session. We should just be an hour, sort of starting here and getting to the top of the hour and wrapping up, but we'll have time for questions and answers at the end, and we'll have a few polls along the way to keep you engaged. We love your quick feedback to some of the polling questions that Jeff's put together. So Jeff, you want to bring your...
Okay, thank you, Jeff.
There we go.
Can you see my screen okay?
We are on MPI quarterly returns. I think you jumped ahead of...
Yeah, well, I was trying to. Okay. So you should see CRE market update, right? With my picture and Terry's picture.
That's where we're at. Perfect.
All right. So Jeff introduced Terry, but again, Terry is the chairman and CEO of Tallen Capital Partners, privately held vertical integrated retail and mixed-use real estate investment and development organization. Has offices in San Diego, San Francisco, and Indianapolis. You may be wondering about the Indianapolis, but that's because Terry was an IU grad. And Terry, you'll notice I put down there that you were the co-captain of the 1979 and 1980 Hoosiers football team, 15th nationally ranked, and won the Holiday Bowl. So, and we have a football team again this year, don't we? What is it, 2-0 in the Big Ten and 3-0 overall?
We sure do.
Yeah.
10th ranked.
And I'm sure part of their success is a result of the new Indiana University Terry Tallen Indiana football complex.
Oh, thank you, Jeff. The university did a terrific job with the facility.
So enough of that, but had to give Terry the credit he deserves for all his support of Indiana University, both the real estate program and the football program. So quarterly returns, I think a surprise to a lot of people, turned positive this quarter after being negative last quarter. When I did the webinar last quarter for the institutional investors, most of them thought we were going to have at least one more quarter of negative returns. This does kind of mask differences that we have between industrial warehouse still doing quite well and retail kind of pulling down the returns. And that's one of the reasons we brought in Terry, is to give us more insights as to what's going on in the retail sector when we start to drill down into that as we make our way through the slides. But as I mentioned, the total return did turn positive this quarter. I think the big question is it going to be a V-shaped recovery, which is starting to look like, or if we go back to the 1990s recession, we see that it was kind of a sloppy W. Looks like my handwriting if I tried to do a W. So hard to know this time. Are we going to have a V, or is it going to turn into a W, or who knows what? Most people seem to think we're going to kind of bounce around the current level for a while. I actually just added this morning. We don't want to get into politics certainly, but Cushman & Wakefield recently came out with a study actually using the data that I draw upon a lot for the webinar from the National Council of Real Estate Investment Fiduciaries, NCREIF, which is data from all the large institutional investors. And they concluded, it doesn't really make a whole lot of difference whether that's the Republicans or Democrats that hold the office. Returns are pretty much the same on average, no matter who the president is. So that's maybe good to hear, since we're not sure still how this is all going to turn out. There is kind of a mixed signal this quarter between what's going on with NCREIF and what's going on in the REIT market, publicly traded REITs. In fact, let me jump ahead to the next slide for a minute. You can see where this quarter, the orange line, the NCREIF Property Index, think of that as private equity, direct investments in real estate. Those returns, as I've been saying, went up, but REIT returns came down from where they were last quarter. And we saw that big drop in REIT returns a couple quarters ago when COVID was first an issue. And as you see back in this previous slide, we had this 12% drop, and actually the most drop was even more than that at 1.4%. for REITs. And yeah, some people think that REITs are really an indication of what's happening in the private equity market. I don't really believe that. I think REITs get carried along with what's happening in the stock market and overreact from time to time. Maybe, in the long run, they reflect the value of the underlying real estate, but in the short run, I think a lot of things can be driving what's going on with REITs that aren't necessarily impacting the underlying real estate. So we do have that kind of mixed signal this quarter. And again, hopefully the real estate returns are going to stay in that positive range. If you look at write-ups of properties versus write-downs, there's like 8,000 properties that are in the database that we look at every quarter. And you can see as we went into past recessions, the write-downs increased dramatically, and the write-ups, dropped way down. This quarter, it again kind of looks like a V in terms of what's happening with the write-ups, but we don't really know what shape it's ultimately going to take. Just a lot of uncertainty right now, I think, as to what the direction of the market is going to be. So we want to get your idea as to what direction you think it's going to take, and maybe think of this as we're going to go back into negative territory on average for real estate, where it'd be below a 1% return by the time we end up at the end of the year. Okay, remember we're around 0 right now for the first 3 quarters. So is the fourth quarter going to drag us back into negative territory of below 1% negative, or just 0 to 1, or we're going to end up being in positive territory?
Polls are coming in fast, Jeff. Let me give them one more second and we'll wrap it up and get you the results. All right. Here we go. Can you see that, or do you want me to highlight it for you?
I can click on it here. Let's see. Okay, we have we have the majority, 53%, saying 0 to 1% positive. 19% think it's going to be negative 1 to negative 0. Only 8% think it's going to be below a negative 1. And there are 3% that think it's going to end up being above 2%, which would be a strong recovery. Could happen. Get that vaccine, right? And things could turn around pretty quickly. And retail starts helping us out again, Terry. In fact, as we'll see, retail was less negative this quarter than it was last quarter. So on average, I think the group is kind of optimistic. So, oops. Okay, so cap rates, which of course we kind of use as an indication of how real estate is being priced, we're down slightly this quarter, and the spread over the BAA bonds is wider, which is always good to see, because that's kind of a margin that we have for increases in interest rates, not pushing up cap rates. We've always had concerns, not always, but recently had concerns about cap rates going back up and pushing values down. But so far there hasn't been really any indication that cap rates are on the rise. In fact, they pretty much either stay at the current level or drop off a little bit. And because of that, market values have actually stabilized. If we look at an index of real estate prices, we see that they of course rose pretty steadily up until about a year ago, dropped off a little bit, but then have leveled off kind of at the current level. So market values are holding steady nicely. As we'll see later on, of course, there has been drops in rents, but I think a lot of that is considered to be temporary drops in rents, and those tenants will start paying rent again. I know, Terry, you've been involved in some lease renegotiations where people stop paying rent for a couple months, but they're going to start paying again, right? And make up for it over the next year.
They absolutely are. There's been a lot of restructuring that's gone on in the leases, especially with the mom and pop tenants, which is an important thing for landlords to do now.
And from what I looked at and some of the examples you sent me, it looked like you pretty much end up at the same point as you would have under the original lease. Just take a little bit longer to get the actual cash, but in terms of present value terms and effective rents and other things we look at, it looks like you pretty much end up about the same as you would have originally.
That's correct, and it's surprising to some people at the beginning of the process of doing rental abatements or rental deferrals. And of course, those are two separate categories that have both worked effectively for a lot of landlords and tenants. But the simple facts are, with the government shutdowns of a lot of cities, with the restricted access to a number of businesses, that the retailers that do need help. The restaurants need help. The dry cleaners need help. So it behooves us to help them during these periods of time, because some of these spaces go vacant. It could take years to release. It's better to have an occupied, thriving center. For rent signs, for lease signs are a little bit of a downer for people. So it's great to keep the tenants in place to work together, and it's worked effectively for most landlords.
Good. So what do you all think will be the change in market values during the next fourth quarter? It's kind of related to the last question, but do you think market values are going to drop? It's a little different than returns, because one of the reasons returns were positive is because of the nice income return that we have for real estate. So we could have a positive return, but values drop. But do you think values are going to drop 1% or more, drop between 0 and 1%, increase 0 to 1%, or increase more than 1%? A lot of these questions I had to update from last quarter when people were more pessimistic. Had a lot more negative choices before.
Yeah. Change things around, and we got a more diverse response here. So let's wrap it up and get you the results.
So we have 18% drop 1% or more. 44% say it's going to drop between 0 and 1%, and 33% think it's going to increase 0 to 1%. 4% increase more. So it's a little bit more towards the negative here. So we can kind of conclude, putting this one and the last one together, that values may drop a little bit. Consensus is values may drop a little bit, but the return that we're going to get from the income is going to offset that enough to, on average, bring returns back into the slightly positive territory, which is good. I think that's kind of, if we can stay at this level and weather through this until we get the the vaccine, the world starts to move back towards the normal, new normal, whatever that's going to look like. That's good. So the components of the return are the result of cash flow that you get, any increase in net operating income, and of course the cap rate changes, what people are willing to price that net operating income at. And this is annual to kind of smooth things out, but in general, I think the conclusion is the cap rate declines, which means you're getting higher prices for the same income, kind of offset the fact that we had some negative net operating income growth over the past 4 quarters. So put the two together, and as we saw, we ended up with values kind of staying about the same level. So Terry, here's the results by property type. Apartment, we had a negative about 1.75%, and industrial, these are quarterly and unlevered returns, just to make sure everybody's clear, unlevered and quarterly. So for example, industrial, 2% quarterly would be over 8% on an annualized basis, and that's before, if you lever it up, so anybody that had industrial warehouse, that's mainly warehouse properties, did very well. Office was positive. Retail was slightly negative, but as we'll see in a later slide, not as negative as it had been before. So Terry, I'm going to put you on the spot. This will remind you, I didn't mention Terry was a student way back when. So this will bring back bad memories, right? So
you're responsible for this.
I'm starting to hear some talk lately. Well, I won't give you my opinion, but I'm starting to hear some talk lately. Well, let me back up. As you know, we tend to talk about properties as being either core or non-core. So core is your lowest risk properties, and then you have non-core, which would be like value add or opportunistic properties, which are even riskier. And hotels have never been really considered core properties. because you don't have the long-term leases and a lot more volatility in returns. And they're not on this chart, but they got killed, as everybody knows, the last couple of quarters. So somebody had the nerve to say that maybe retail is not core real estate anymore. Would you agree with that?
I would not agree with that at all, as you could imagine. There's diversification in all the different product types, and when you have a well-located food, drug anchored shopping center, those are still very much desirable. The grocery store, the drug store that provides a necessity-based retail. You also have a lot of retail product in what you would call core markets, urban markets that are doing well. We know the malls have taken a hit for many reasons, and we're going to peel back the few layers on this as we get into the different property types in retail. But the malls have been hurt because of limited access. Some of the retailers that are in the malls have been on a slow death spiral anyway. But one of the things I want to absolutely state is that bricks and mortar isn't dead. Retail isn't dead at all. You will see a number of retailers and restaurants that are thriving right now and doing better than they have in prior year. Their stock prices are up versus a year ago. So retail isn't dead. There's just about 20 retailers that are, and that's what we're experiencing right now. So the trick is how we backfill these spaces, how we have more mixed use product, how we bring medical in. So you're going to see a mix of product types. So retail, as we've known it, is going to change, but it's still alive and well.
Good answer. Another former student, David Simon, seems to be doing well, buying up some of the retailers that are in trouble.
That's correct. He's buying J.C. Penney, Brooks Brothers, and Lucky Brand jeans. And David had mentioned the other day on an investor call that everybody was asking why he was doing it and what was the wisdom behind it. He said, "You can buy a solid business for a discounted price. Why not?" So he's going to create some value here and keep his malls leased. And I think Jeff and I are both shareholders also.
That's right. That's right. And this chart kind of reinforces, the fact that you got to look over a longer time period and think about the diversification benefits of being across the different property types. And if you look at the retail, the blue line, you'll notice in the 80s, like look, 85, 86, 87, 89, retail was the best performing. Then you had a period 95, 97, 99 up through 2001, retail was the worst performing. Then it was the best again, 2003 up through 2000, at least 2005, 2006. It was even the best performing, even though returns were negative during the more recent financial crisis. It was the least negative. And, so the fact that it's a negative now doesn't mean it's always going to be the worst performing sector. So if you have a diversification strategy, you certainly don't want to bail out of retail. And maybe if you have a buy low, sell high strategy, right? Now's the time to buy. Discount rates for the different property types, and this comes from valuations of the properties done by Altus, that does the appraisal management for a lot of the large open-end funds. And you can see discount rates have gone up on the retail properties, maybe a risk premium, because when you're talking about discount rates, it's really just risk differences that should cause differences across the different property types, even comparing real estate with other asset classes. So maybe there's more of a risk premium in retail than there should be right now. Hard to say, I guess, until we see how things shake out. But that sort of reinforces that you can get a higher return buying retail properties now. Whereas if you go back to like 2016, 2017, it had the lowest discount rate. In other words, investors were willing to buy at the lowest rate of return back then. Now they want the highest rate of return of all the different sectors in order to buy retail properties. And then similarly, cap rates, you can see how they have come down actually for retail, but then come up just a little bit this last quarter. kind of reflecting what's going on with the discount rates being higher. Apartments, you can see, have actually dropped quite a bit. We're going to drill in a little bit more on the apartment cap rates here in a minute, because there's, I think, kind of an interesting dynamic that's going on with the apartments right now. In fact, that's the next slide here. I actually had some questions coming in from some members of the NACREIF organization, from some of the institutional investors. What the heck is going on with apartments that the cap rates dropped so much this quarter? Normally cap rates go down when you're expecting a lot of future growth in income and value for properties. But I think it's a little different going on this quarter. So this is sort of a cap rates 101. The cap rate is, of course, net operating income divided by value. What's important to realize and remember, sure y'all know this, but NOI is your current net operating income, where value is really based on what you expect to happen in the future. Normally, the greater the expected growth in NOI, the lower the cap rate. But what's really going on this quarter for apartments, and to some extent, I think, as Terry kind of alluded to earlier with retail and other property types, is we had a rent drop that's really being viewed as temporary. So the net operating income dropped quite a bit this quarter, especially for apartments. It was down 9%, whereas values were only down 0.2%. So what that's telling us is, we had this drop off in rents. People weren't paying the rents, but that rent growth is expected to turn around, and rents are expected to start increasing again. In fact, I just saw something this morning in the news where apartment rent collections was up a little bit this quarter or this month, I guess it was, from last month. So I think the value is still being viewed as being based on longer term increases in net operating income. And so it's really just a temporary drop in NOI this quarter that's caused those cap rates to drop. So we did have a pretty significant drop in cap rates from 4.3 to 3.8, but I think that's, again, due to the fact that NOI just dropped a lot more than values, which is not what we normally see. So where do you think cap rates will be for the nation by the end of 2020? And we realize that cap rates vary a lot by property type and quality of the space and geographic area and all that. So just think of this as for institutional investors, where we're currently right around 4.5%. So it's really, think of this as a question of whether they're going to drop or increase. So if you pick A or B, you think they're going to be lower than they are now. If you pick C or D, you think cap rates are going to go up from where they are right now. Something everybody's trying to figure out.
That seems to be the question of the day, and I'll get you the results. It looks like the bias is to the stepping
a little bit to the upside, right? 33%, 4 to 4.5, and then 43%, 4.5 to 5. Actually, 21% above 5.
But somebody came in just under the wire below 4, so I didn't. Maybe that's looking at NOI dropping. It might be using that same theory that you just presented.
Yeah, that's interesting. So what would push cap rates up? That would be some more uncertainty. That would be interest rates going up. Now, actually, if inflation comes back, and we haven't seen much sign of it yet, the Fed would like to see it, but hasn't really happened. That always has tended to keep cap rates down, because again, inflation pushes up future rents and property values. So I guess the slight rise in cap rates would be consistent with the response that we got, that values were going to be down a little bit this quarter, but not enough to result in negative returns on average. Interesting. Our market rent growth across the different property types. So again, retail is not getting much respect here, Terry. And industrial, the best, probably no surprise there. Apartment rent growth is actually stabilized. Got to be a little careful in just one quarter data, but it kind of looks like it's stabilized, and then that's followed by office, which is also kind of stabilized. And actually the retail, even though it's the lowest rent growth, it's kind of stayed where it was last quarter, so it hasn't gotten any worse. So maybe there are some signs of kind of stabilization. And then this is your NOI growth. This was rent growth. This is your NOI growth. Ouch. Last quarter was not too good in terms of the NOI growth for retail. Minus, well, I take that back. The minus 30.45 was the second quarter of 2020. So for the third quarter, this most recent quarter, it's actually only just very slightly negative. So actually, that's really a big turnaround, isn't it, for retail from last quarter?
Yeah,
So
that's a nice increase.
That must be all those people that didn't pay during COVID that are now paying. I mean, that's a huge difference from minus 30 and then all the way back up to essentially zero.
Yeah, I think it's a lot of the systems and procedures being put in place, people right-sizing their ships. The PPP money helped during that period of time also. So there were a variety of factors.
Would your guess be that we're going to kind of stay, more where we are now, or maybe even start to see some positives in NOI growth for retail? Well, overall, I know we're going to drill into the property subtypes here in a minute.
Well, we think so. One of the things that's going to be, fascinating to watch is what does the consumer do this holiday season? Are people going to get back into the retail stores? Are people going to want to be out there experiencing shopping? Or have new habits been created where there's more of an Amazon type buyer? The retailers that are going to be successful, that are successful, are the omni-channel retailers. So they're taking advantage of all the various loyalty programs and ways to engage their customer with more experiential retail. But this is going to be a very fascinating holiday season to see how people react, how our consumers react.
Good. So this is the rent changes for the retail subtypes. So one of the reasons I asked Terry on the call is he knows a lot more about what's going on across these different subtypes of retail, certainly than I do. And so if you could give us some insights into sort of, does this make sense, first of all, in terms of the which subtypes increased, which subtypes decreased, and who do you think, maybe some examples of tenants within each category, who the winners are, who the losers are. Tell us all you can about what's going on in retail.
Okay, thanks, Jeff. Also, I just want to say it's great to be here with you today again, and it's great to be with Jeff Finn. I just wanted to mention something about RealNex is that our teams use the RealNex platform every day in our business, and it's been a great help to our company. And I encourage all of you to explore what you can do with RealNex. The most favored retail product types have traditionally been the community and neighborhood centers. So you can see on the chart that they're performed the best. This goes back to what we spoke about earlier, the necessity-based retail. So these are the big grocery chains. These are the drugstores, the CVS's, the Walgreens. We're seeing that the grocery category is doing very well. We'll see some fallout in the revenues from grocery stores as more and more restaurants open. They pulled a little bit from that category. We're seeing that a number of grocers are expanding now, which is a great sign. But we want to temper that also with how the earnings are going to be as we get back to the opening of other types of venues for consumption. The power centers have been absolutely hammered. We've seen a lot of bankruptcy in that category. The Steinmarts of the world, the Brooks Brothers, those types of tenants have gone out. The power centers are going to be challenged. They also tend to have a lot of health clubs. The closure of 24-hour fitness has been detrimental to that category with the number of stores that they've had. Just from the fact that they've had their bankruptcies, then you also have the closers that are, they're never going to come back. Then you also have the fall off in traffic. Traditionally, power centers were not interested in having movie theaters or health clubs. And then through the last recession, they picked up, changing the use provisions in a lot of the contracts to allow for health clubs because of the regular traffic that they bring. So there's a variety of factors hitting the power centers, and there's also some tenants in those categories that were pretty much on their last legs anyway. It's good to see that the regional malls and the super regional malls are performing or are not losing rent. We talked about the J.C. Penney's of the world, which has been in trouble for a long time. Simon's buying those to get control of the real estate, not to operate the company, is what many of us believe in the long term. It's a real estate play. It's what Sears had been. Now you're seeing, the bankruptcy with Neiman Marcus. That was a household name for many, many decades. Lord & Taylor has been around forever. Even with Brooks Brothers. Brooks Brothers is the oldest retailer brand in the clothier category in the United States. They were founded in 1818. So we're seeing a lot of retail that is not keeping current. We were kidding around a little bit before the call today that Sears and Amazon, the contrast is amazing, because Sears had the Sears catalog. Those of us who are a little bit older remember that, and that was the #1 retailer, and everybody looked forward to that Sears catalog. And Sears became a dinosaur. Sears stock is 18 cents a share. Amazon's stock is over $3,100 a share. So if Sears would have been forward thinking in some sense, they could have been Amazon or something closer. One of the things that's interesting that you have to, this talks about peeling back the layers a little bit. In the power center category, you're seeing the rent declines in groups like Bed Bath & Beyond, Pier 1. But what you don't see in that category are the ones that are thriving. Walmart, Target, Costco, they are all thriving through this period of time. Example, Walmart stock is trading at about $149 a share today. A year ago it was $120 a share. Target's stock is about $162 today. It was about $110 a share exactly a year ago today. So these retailers, along with Costco, have really figured out how to fill in the gaps and be facile in this time to improve their to improve their sales. But again, they own their real estate. They're not tenants. So if you do have an opportunity, those of you who are owners and investors and have an opportunity to do a lease with a Target and a Walmart, we can tell you from our own experience, they've been great tenants to work with, and they're great stabilizations, and the rental checks are as frequent or as regular as you'll find from anyone else. One of the other things that you're seeing in the single tenant category, that's something Jeff and I talked about that we're going to do a little bit more research on, because that's a broad category. In the single tenant category, in the community and neighborhood shopping centers, what's going on is that the drive-through restaurants are absolutely thriving. Chick-fil-A, In-N-Out Burger, Chipotle. Well, Chipotle is actually going into the drive-through format now. Denny's is even going into a drive-through format now. But the drive-throughs have been a constant benefit to those restaurants that have them, because people can't go inside, you can't sit. There are a number of studies out about the most efficient drive-throughs, the highest volume drive-throughs, and Chick-fil-A and In-N-Out Burger continue to rank absolutely at the top. So those are some of the winners. Other winners in the restaurant categories that are not drive-throughs are Wingstop, Chipotle. My goodness, Chipotle's stock was $753 a year ago. Today it's over $1,200 a share. It's an amazing increase, but they adapted. Their consumers are loyal. They're an omni-channel retailer, and they've done a fantastic job. The losers in the restaurant category are the Cheesecake Factory, the Chuck E. Cheese's. That probably doesn't surprise anybody. Sizzlers, CPK, Soup Plantation. So these are larger format restaurants, some of them with buffet structures that are probably never going to come back. So we do see a some silver linings, and one of our slogans is we're mining for silver linings in this environment. And in the power center environment, one of the silver linings is while the rents have fallen, the opportunity to renegotiate anchor tenant leases to more favorable operating terms is a big benefit. So that might mean if you have a Ross Dress for Less that comes back and asks for a rental reduction, even though they're probably doing quite well during this environment, you may be able to reduce some of their prohibitive uses. You may be able to get additional option terms and more favorable rates. So there are a number of silver linings in this environment.
All right. Very interesting. And as a reminder, send in any questions that you might have. As you can see, Terry, knows more about retail than about anybody. Jeff, did we have any questions come in?
We have several. Let's take them from the top then. The question on your discount rate chart, what were they based on 5, 7, or 10-year holds, or did it?
They were mostly all 10-year. Whenever people do the Argus runs, they almost all use a 10-year holding period.
And a question about the forbearance programs, and if as they end, where do you see impact on both multifamily and commercial?
Terry, do you have any thoughts on that?
Well, it's yes. You have to manage your budgets. It might, because you're going to be paying more debt service than you had in the past in an environment where you are working every day to maintain your rents or hopefully get new tenants in some situations to increase your rents. But the fact of the matter is rents are falling, as Jeff has shown, and those things are going to affect your debt service payments. We're spending a lot. We've gone into forbearance on a couple of projects because it was a favorable opportunity. We work closely with our lenders and our tenants and our property managers. So I think that those of you who are dealing with forbearance and having the increased payments or the deferred payments starting to kick back in, that to really spend that extra time on your budgeting and your planning. You may be taking a lower distribution in the meantime, but in the long term, I think we'll all be fine.
Okay. We can come back to questions, Jeff. We'll kind of go through the rest of these slides quickly. So for apartment subtype, you can see high rise is what got hurt the most, followed by low rise. Garden still slightly positive in terms of rent change. I think that's a story about both density and the high rise being in the CBD areas, where there tends to be more demand for apartments in the suburbs right now. And then for office, kind of consistent with what I just said, the suburb rent changes were quite a bit higher than the CBD, although both positive. Occupancy has been holding steady, although I think that may be a little misleading because this particular data is whether the space is leased or not. So even though people may not have paid rent for a couple of months, they didn't break their lease. They may have renegotiated it, but through this time period, the space was still technically leased. So the way the occupancy is measured here, it pretty much held steady, except of course for hotel. Hotel just got killed in terms of the occupancy. Wow, look at that, 15% occupancy for hotel. Hard to survive in that kind of situation. What property sector do you think will perform best in 2021? Notice that it's 2021. It would have been too easy to say what it would be for the rest of this year. So 2021, is the momentum going to continue for industrial warehouse, or could it be apartments? I think the long-term demand, if immigration picks up again, especially, could be good for apartment. And I saw an article the other day that people are becoming less and less homeowners now. Could maybe build a case for office, and maybe Terry convince you that retail is going to have a big turnaround.
I'm all for that, Jeff.
So let's see. Wow, this is just like the institutional investors. They all thought it was still going to be industrial warehouse. Although 21% are apartments, 5% office, 8% retail. Sorry, Terry.
You got some votes.
And zero hotel. No votes for it's hard to believe hotel is going to certainly not next quarter, right? Or probably in 2021.
It was interesting. I mean, with this response, Jeff, and your last chart, the strength that office is holding up, given the environment where people aren't in the office, and so many people are working from home, and companies have decided to have work from home strategies long term. It's interesting to see office holding up so well in the rental and occupancy.
Yeah, well, the debate seems to keep going on as to what's going to happen with office. You got arguments that now that so many people have been working at home, they're going to keep working at home. You got other arguments that you're going to have more space per employee to spread people out, and people are going to be anxious to get back to office buildings. And I suspect it's going to depend a lot on the particular type of tenant. And there's going to be winners and there's going to be losers within office, just like we talked about for retail. But how it's all going to shake out, I'm not sure we know yet for office. Number of transactions is still way down, which makes it harder for appraisers, and there's less liquidity in the market. So hopefully that'll start to come back. There is less capital flowing into the large funds, although it's only slightly negative. It's nothing like during the recession when there was a huge queue of investors trying to get out of the funds, and the capital flows were negative. The distributions, because of people asking for their money back, was a lot more than new money coming in. We still have new money coming into funds as well as money going out there. There are some queues on some of the funds of investors wanting to take their money out. But I'm not hearing of any serious problem in terms of capital. In fact, if anything, I'm hearing there's capital on the sidelines, just kind of waiting to see what's going to happen and put that capital to work. Lots of debt capital out there too.
You've used it in the past, and there's some people that are still they weren't on past sessions, so they don't know the ODCE, your ODCE acronym.
Oh, yeah. So this is open-end diversified core equity funds. So I just picked out this particular one because the organization that I've mentioned, NCREIF, tracks the capital flows into and out of those funds. So these would be funds that are open-end funds, so you can put your money in. In theory, you can take your money out whenever you want, but there's always provisions in the fund agreement that if there's times like we have today where a lot of people want their money out and you can't do it without selling properties, you have to wait in line to get your capital back out. But in general, they're open-end funds as opposed to closed-end funds where you put your money in up front and they have a finite life and you can't take your money out until the fund is liquidated after 5, 7, 8 years. These are your core funds, but I also looked at the chart for the other open-end funds that are more the value add, and it's pretty much the same story, just slightly negative capital flows. So again, ODCE stands for open-end diversified. The ODCE stands for open-end diversified core equity funds. So I think this is our last question. What do you think is the most likely direction of the market over the next 4 quarters? That's a more general question, maybe highly correlated with the other ones that we asked, but do you think returns are going to turn negative again? Values will decline. Returns and values will probably bounce around the current level. Returns will continue to increase and values will rise, or you have no idea?
at the beginning, it was a very honest audience because the initial spike was, I have no idea. Now it's getting spread out a little bit.
It's kind of what I would expect. Bounce
Right.
around the current level is kind of, I'd either have to pick that or I have no idea, which may be similar to saying it's going to bounce around the current level, right? Although you hopefully, I mean, there's always these black swans, right? That by definition you didn't know they were going to happen and just cause havoc in the market. So kind of a summary, and then we'll turn back to questions. But national returns did turn positive, primarily due to the strong performance of industrial, although all the sectors improved from what we saw last quarter. Retail continues to be worse, sorry Terry, but returns are up from last quarter. Transactions up slightly, but still really the second lowest level of transactions since the financial crisis. We do have less write-downs and more write-ups than last quarter. Cap rates are holding steady, and values are holding steady. And from our polling questions, it looks like everybody is kind of slightly optimistic, although you may see some slight declines in values. You still think returns are going to hold steady, kind of bounce around the current level. Nobody sees any drastic drops in returns and values, or any big increases in returns and values. And maybe that's the best news we can have right now. Terry, any final comments, or Jeff, have any questions we didn't get to?
I think you covered the questions. We still have time, certainly, for more questions to come in, but of the questions that have come in, I think the only one we jumped was the cap rates, and I think this is unique. The question is, are these going in cap rates? And I think these are ongoing cap rates that you have with NOI and value, because these are mark to market.
You could call them a going in. You could call them a going in cap rate.
But it's not just based on transaction. This is actual based on NOI and value, or
right. One way to think of it is they're implied, because actually the cap rates that I showed from Altus were based on valuing the property by discounting cash flows over a 10-year time period,
right,
but then dividing the net operating income expected next year by that implied or by that discounted value, the value from the discounted cash flow analysis. So it's kind of an implied cap rate. It's not from transactions. It's a result of doing a discounted cash flow analysis.
That's what I clarified that one. And then what are you either seeing, or what do you think appropriate in the current environment on spreads on 5, 7, and 10-year horizon investments? What's the different expectation?
For by 5-year, so that would be spreads for different holding periods for the property. I'm actually don't think that the return you should expect should be different whether you plan to hold it for 5, 7, or 10 years, because I think the resale price is going to reflect what the next buyer is going to want going beyond that. So if you expect to sell after 5 years, the buyer in 5 years is going to be looking out over the next 5 years. So I'm not sure the answer would be much different than if you expected to hold it all 10 years. Kind of a theoretical answer, but
yeah.
I think there's been some work on how duration of leases varies, which is kind of interesting. But I think in terms of, it's hard to think about duration for real estate itself, since you can sell it whenever you want.
Yeah, the spreads on the debt side, but not necessarily on the equity return side. For the number of questions have come in about getting copies of the deck, and yes, the deck will be sent. We will also send a recording out and replay early next week. And I guess maybe it was directed at you, Jeff, but maybe Terry, you have a perspective on this as well. Are you concerned about 1031 and capital gain changes and the impacts that they might have in the market?
Good question. And if it turns out Biden is elected, we could have more capital gains tax, right?
Yeah, it seems like that the agenda if Biden is elected, that they'll probably do away with the 1031 exchange, and we'll probably no longer have the beneficial long-term capital gains. So it's a sobering thought. 1031 exchanges were originally created to, preserve the wealth predominantly of family farmers that had passed the farm down through the generations. It's now become a great wealth building tool for many investors, and it has been for quite some time. So it is concerning because when once someone wants to liquidate, or it goes into an estate to liquidate a previous 1031 exchanges, the tax ramifications could be very substantial. The 1031 exchange, of course, allows people to keep investing. It keeps the viability of deals and your net worth going forward. We're seeing that a lot of the credit tenant 1031 exchange properties right now are triple net properties that are traditionally sold into 1031 exchanges are maintaining very good or very aggressive cap rates. As Jeff, you had shown, the cap rates have become lower in some situations. So it is concerning, and it's hopefully there'll be some bargain made where it won't be draconian, but it is a very big concern right now.
Yeah, it seems like for a number of people I've been talking to and working with, it's a market by market scenario of how active people have been, but there's been some tremendous activity, and it could be in part, I think, significant part because of 1031 transactions being made this year, and people.
There's also been some academic studies that have shown 1031 exchanges have actually led to people investing more in properties than they would have otherwise.
They create a lot more liquidity for sure. Let's see if there's one more. Yeah, it's just they're more of the same. So I think we're ready to wrap up. We appreciate everyone joining us. Terry, thank you so much for coming in and giving a perspective as you have, and Jeff, as always, to give us this macro view of what's happening across the industry. Great
Thank you,
insights.
Jeff.
And
thank you, Terry. Go Hoosiers.
That's right. Go Hoosiers.
Take care, everyone. Thanks again for joining us. Bye-bye.